Passive income investors. I want to bring you an update on what is going on right now because the situation's gotten crazy. The last week has been crazy what's going on in Iran. And I want you to get a good idea of what's going on, what defensive assets you have available so you can withstand this current stock market and to come out as a winner. Briefly, we're going to go over the current situation. Then we'll talk about some of the key players that are out there, some players you can make some money on because they're involved with this space right now with the defensive industry and involved with the war that's going on right now. So it's up to you to decide. You tell me, what do you think is the best, is it a perfect time to get into some of these stocks? Or should you just hold off because you may have missed the boat because the stocks have gone up a little bit since the war started this past week. Let me back up. I don't want to use the term war, but you've got to be careful because all these little disagreements, what's going on right now, I want you to tell me as your president, what do you think is the best decision we should do right now? Watch this video. Give me your feedback. Let me know what's going on, and we'll come with the best decision at the end. May the best investor win.
Appearance there. We saw predictable market movement, perhaps, at least initially, the rise in gold prices, lower yields on U.S. bonds. But it seems as though the signals are not entirely clear. Joining us now from Chicago is Charlie Burman. He's vice chairman and head of the investments group and portfolio manager at REL Investments. Charlie, it's great to see you. I think investors are having a tough time here sussing out what exactly they should be doing as we see this drop in oil. One of the questions we were discussing in our meeting this morning is, if you're an investor, which of these indicators do you look at? Because things aren't necessarily showing a clear picture of how we should interpret what's going on.
Yeah, so I would say versus a year ago, the whole market was nervous. We had an inverted yield curve. We had people predicting a recession. Everybody's worried about Brexit. The market was clearly pessimistic. Bond yields went to 135 on the 10-year. The market was pessimistic. And so the right thing to do at that time was to be greedy when others were fearful. It was to buy when there was maximum pessimism. Today, it's a little different. In fact, I would say right now, there's general optimism. A lot of the optimism gauges are showing that people are bullish. Unfortunately, retail investors have a bad habit of putting money into stocks after a run-up rather than when stocks go down, which is when you should buy. So we would say today the market is fairly priced. Value stocks are clearly cheap versus growth. Bonds are very expensive, so you should avoid long-term bonds. But I can't pound the table on stocks like I could a year ago.
Charlie, we saw gold go over $1,600 an ounce last night. It has fallen back below. You just talked about people timing the market, but we know you shouldn't do that. At least we're told not to do that. But how do you protect yourself if we have enjoyed the run-ups we've had in different asset classes if you are nervous?
You know, that's a great question. I think what you have to do as a value investor is try to find stocks that are inexpensive relative to their underlying value. And I can't tell you which way the market's going to go next month, but good investors can tell you what is attractive relative to its value. So for example, something like KKR, which is just a wonderful business, attracting significant inflows, a great economic model where they sometimes get paid 2 and 20, that stock trading at 13, 14 times PE still represents good value, and it's going to do well over the long run. There are other names that we like, so you should look for what's cheap. And generally what's cheap are value stocks, some stocks that maybe are a little bit cyclical. What's expensive are safe stocks, bond substitute stocks, high dividend yielding utilities, REITs, Coke and Pepsi, which are very low beta. Those are not cheap, and so you shouldn't buy them.
Charlie, there's been a lot of talk about this rotation into value from growth, right? And there's been some signs that perhaps it's going to be a little bit more sustained. But we've sort of seen feints in that direction before that have not been sustained. So what do you think is going to change sentiment around those stocks? Because, I mean, it's great to buy value, but it's got to pay off at some point, right? It's got to get more expensive at some point if you want to make some money.
Yeah. No, this has been, as value investors, this has been the most painful 10 years in the last 100 years. I mean, there have been some wonderful studies done that have shown that value has outperformed growth in every 10-year period since we've been able to calculate these things, which is basically 1925. If you look at 10-year periods since 1925, value has beaten growth in every 10-year period except for the last 10 years. And that's just been very hard on people like me. And but the good news is we're making a lot of money. It's not like we're losing money. It's just that we're not doing as well as the growth investors who are buying Facebook and Netflix and Amazon. And so I'm asking people to hang in there. It's been tough. I know there have been head fakes, but we really do think the gap between value and growth is significant, and now would not be the time to sell your value stocks and buy growth.
Escalating tensions in the Middle East have dragged the broader markets down, but defense companies have gained considerably so far this week and could continue to do so. Rising possibilities of a war between the United States and Iran could spur demand for military weapons and equipment. In the past 5 sessions, as of January 7th, the S&P 500 Aerial Defense Index gained 3.7%, and the Dow Jones U.S. Aerospace and Defense Index climbed as much as 3.6%. U.S. and Iran is on the brink of a war right now. Hostility between the two countries, United States and Iran,
Speaker Nancy Pelosi announcing that the House is going to vote on that resolution.
Hostilities between the United States and Iran increased following the assassination of the latter's top military chief, Qasem Soleimani, on January 3rd. Soleimani was killed in a U.S. airstrike authorized by President Donald Trump. Since then, Iran has taken considerable retaliatory steps against the United States. The Islamic Republic announced that it will no longer abide by a 2015 nuclear deal with global powers and launched more than a dozen ballistic missiles against military bases housing U.S. troops in Iraq on January 7th. To this date, no one has been confirmed killed or injured. Secretary of Defense Mark Esper said that although the United States doesn't seek to start a war with Iran, it is prepared to finish one. The U.S.-Iran relation has been rather rocky given tensions over a 2015 nuclear deal, but hostility spiked last year over U.S. economic sanctions on Iran and a shooting down of a U.S. drone over the Strait of Hormuz. Last year, large arms manufacturers across the industry told investors that the rising U.S.-Iran conflict could be good for business, according to Intercept. Thomas Kennedy, the CEO of Raytheon RTN, indicated that Iran, in January 2019, is one of the demand signals that could shape the U.S. defense budget. Marilyn Houston, CEO of Lockheed Martin Corporation, LMT, also spoke of increasing threats from Iran during the company's investor call last January. Shares of prominent defense contractors such as Huntington Ingalls Industries, HLL, Leidos Holdings, LDOS, Northrop Grumman, NOC, Raytheon, and Lockheed have moved north since the assassination of Soleimani, beating the broader market.
Hacking attempts on the rise. In the 48 hours following the strike that killed Iranian General Qasem Soleimani, hacking attempts traced to Iranian IP addresses nearly tripled, according to network security company Cloudflare. Sextera Federal Group Chief Information Security Officer and Executive Vice President Leo Tadeo and Yahoo Finance's Julia LaRoche join us now, along with the panel, to break down the true threat from cyber hacks on financial institutions and banks and governments. Where do we usually see those going? Is it banks?
Right. Well, the Iranians have targeted U.S. banks in the past. We saw in 2012 and 2013, during the negotiations for the Iran nuclear agreement, we saw Iran attacking major U.S. financial institutions over a course of a year, trying to prevent them from doing business with their retail customers primarily. And so we know that's a tactic that they've used in the past, and we'll probably see it again in the future. What they're trying to do is gain attention. They're trying to make it impossible to ignore them. And so while it really doesn't have a financial impact, the banks can recover, the banks can continue to do business, it does put the Iranian issue in the newspapers for the American public and for the global public.
There's never been a great time between the U.S. and Iranian actions. As you see, the history shows the timeline is not recent. It's not just under Donald Trump. It's been going on for a long time, many decades up at this point.
If they were more successful with more substantial hacking, would we find out about
Yes,
it?
we would. So I want to raise that point. The recent U.S. indictments, especially in 2015, of Iranians who did hack the U.S. financial institutions weren't really about putting those Iranians in jail. The likelihood of that is low. It's really about signaling to the Iranians that we can detect it, we can determine who did it, we know the infrastructure, we know the individuals, and so we're telling them they can't hide.
But my question is not so much whether we know that they're doing it, it's whether we know that they're doing it. In other words, we've had many instances of corporate hacking where the corporations have been criticized because they haven't told customers until quite some time later. So I wonder in this.
Back on to some other defensive stocks to consider. Lockheed Martin manufactures prominent missiles like the Patriot Advanced Capability, PAC-3 Terminal High Altitude Area Defense through the THAAD Hellfire Missile, Joint Air-to-Surface Standoff Missile, Javelin Tactical Missile, and a few more. The company surpassed the ZAC's consensus estimate in 4 consecutive quarters, delivering an average of 14.41%. Its long-term earnings growth is 7.1%. Another company is Northrop Grumman. Northrop Grumman's key programs include the Advanced Anti-Radiation Guided Missile, as well as the Integrated Air Missile Defense Battle Command System, IBCS, and a few more. The company surpassed the ZAC's consensus estimate in 4 consecutive quarters, coming up with an average of 11.48%. Its long-term earnings growth rate stands at 13.1%. Raytheon is the company that I currently own, have some assets involved right now. Raytheon is a manufacturer of the Patriot Air and Missile Defense Systems, Standard Missile 3, Advanced Medium Air Range Air-to-Air Missile, AIM-96, Sidewinder, Short Range Air-to-Air Missile, and a few more. The company surpasses ZAC's consensus estimate in 4 consecutive quarters with an average surprise of 8.6%, excuse me. Its long-term earnings growth rate is 10.7%. So after this brief little backstory and everything, and all these other key players right now, is it too late to chase defensive stocks as Iran strikes U.S. bases? This is from MarketWatch. MarketWatch says, traders certainly have shown no reluctance to profiteering from the U.S.-Iranian tensions. Since December 27th, when a rocket attack killed an American contractor in Iraq, the aerospace and defense sector have been the best performing S&P 500 industry group, according to analysts at research service Bespoke Investment Group. Aerospace and defense is currently sitting at 3.4%, followed by energy at 3%, industrial conglomerates at 2.6%, oil, gas, and consumable fuels at 2%, wireless telecom at 1.8%, and then you have the others right after that. Northrop Grumman, Raytheon, and Lockheed are more than 3 standard deviations above the 50-day moving average. Historically, when aerospace and defensive stocks made that big a move without doing so in the prior 3 months, returns are typically weak. Northrop Grumman, for example, has underperformed by 11.8 percentage points when similarly overbought compared with its typical move. Defense stocks are also at the top of Bespoke's overbought industrials list. In summation, while the U.S.-Iran fight over the past couple of weeks has sent aerospace and defensive stocks flying, we would caution against jumping in on this momentum trade at this point because downside mean reversion usually occurs after the group gets as extended they advise. Okay, Raytheon as of Thursday at 10:47 a.m. is sitting at, Raytheon at almost 11. Raytheon at almost 11 a.m. is sitting at $227.89, 92 cents. Over the past year, it has gone up incredibly since it has a big increase from almost $70 to $80 in the past year since January this time a year ago. We bought Raytheon last year for about $191.06. Currently, Raytheon is sitting at 227 as the time is showing for this when this was recorded. So it was a considerable gain, a 19% gain since this was purchased. So it's just all that timing at this point. At the time, Raytheon was doing a merger with another company, and that caused a spike. And then now we have the recent spike with everything going on within the Middle East. Northrop Grumman, sitting at $372.73, has also shown an incredible increase from last year, from a year ago. The next one is Lockheed Martin, also showing an incredible increase from a year ago, currently sitting at $411.03. Martin also showing another increase from a year ago, currently sitting at $414.84, because a year ago it was under $300 at that point. So it's almost just slightly short of doubling in the past year. The next one, General Dynamics. General Dynamics sitting at $181.99. General Dynamics has not gone up as much as the other three stocks that were mentioned. So there is some possibility this one could grow some more. But out of all four of these, General Dynamics does not pay a dividend. So that is another thing to be concerned about and to pay attention to if you decide to get involved in the buy General Dynamics. Passive income investors, we've gone over everything, gone over the detail, the history, gone over these stocks to consider, and you tell me, should you go and buy and add some more to your portfolio right now? Everything is still very fluid. Not really sure what's going to happen in this war. Not going to sure what's going to even happen tomorrow. Anything could change. I mean, Iran could declare peace and everything will come to a standstill, but we don't know. We have to wait and see. So what do you plan to do? Do you plan to get involved and jump into these defensive stocks? Let me know. I want to hear it, and drop your comments below, especially which ones you want to buy, or if you may even own some already. I would like to hear, as well as the rest of the audience here and members of this group. Thank you. I will see you again. Make sure you like this video, subscribe, click the bell for notification, and I'll be back again this upcoming Sunday with another video for you to check out. Take care. Have a great day.